You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hello, everyone, and thank you for joining us today. The stock market has continued its very strange but very strong rebound since the COVID crash bottom just 5.5 months ago. I don't know about you, but to me, it seems like 5 months ago was more like a year ago. But the question today is that I'm starting to hear a lot is the market topping out again? So we're going to talk about that today. But before we get started, as always, a few housekeeping items. If this is your first time listening or watching, then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, CASH stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. Last but not least, while we won't have any visuals today in today's episode, always keep in mind that all links, visuals, charts, and other educational resources are always available on our website at libertaswealth.com. So let's go ahead and get started with this crazy market. The S&P 500, it's at all-time highs. That's what you're looking at on the screen right here behind me is the S&P 500. I've got a dotted, or a dashed line kind of going horizontally across the screen here at the all-time highs. And then the other two dashed lines just mark the last range that we consolidated in before the market headed higher. But the S&P 500 is at all-time highs. That's undeniable here. The Russell 2000, which represents small companies, is below its February highs still. I can actually switch over there so you can see here we're still below the highs. The Dow Jones Industrial Average, you can see, is also below the all-time highs. In fact, it got pretty close here this week, but just obviously everything is selling off this week at the end of the week. And then there's the NASDAQ, which has done extremely well here. The NASDAQ has just absolutely screamed higher in unprecedented fashion off the coronavirus low. But I'm just going to go back to the S&P 500 and leave this on the screen as I discuss this stuff. So something interesting about the NASDAQ specifically, and I know there's been a lot of statistics for those of you who are nerds like me and kind of look around for research on the internet, things like Twitter and what have you. But there's been a lot of news and a lot of talk about the idea that a handful of stocks have made up a big chunk of this increase. And then there's people who argue, well, no, it's not a handful of stocks. There's a lot of stocks. And I mean, obviously, it's all relative. But the fact of the matter, if you look, I mean, you can make numbers do whatever you want, but you can't deny this statistic. And that is that when you look at the NASDAQ as of this past month, 47% of the NASDAQ is 5 stocks. And those 5 stocks are Facebook, Amazon, Apple, Google, and Microsoft. So whenever one of these 5 stocks has a great day, or whenever one of them has a bad day, or let's just say all of them have a good day, the NASDAQ is going to have a great day. And obviously, the faster these things have gone up in value, the higher the probability of a pullback, because the market breathes, right? It doesn't just go straight up in a upward diagonal line. That's not how the stock market works. You know, the market has to breathe and digest and take breaks. It's kind of like these ultra marathon runners that can go for 100 miles, without taking too many breaks. That's impressive, right? And that's kind of what this market's been off the March lows, but that's not normal. So obviously anything can happen. We can continue to see this market continue higher from here. The big drop that we're starting to see at the end of the week is obviously I think it's healthy, but it was also expected. It remains to be seen whether it continues through the weekend into next week. We'll see. There's been a lot of in the past. There's been a lot of times where the market would pull back here to either the 50-day moving average, which is the gray line right here. This is the average movement of the stock market over 50 days. And there's been a lot of times where it pulled back to just the 21-day moving average, which is the average movement of the stock market over 1 month, because 21 trading days is 1 month. And I know earlier I said there weren't going to be any visuals, and I already lied, so I promise I'll put this chart up here on our website at libertaswealth.com for those of you that want to go back. It'll just be one chart, just so I can show you what I'm talking about with these moving averages. But anyway, So what you have to understand, and I love this analogy. The first person to teach me was Tommy Dorsey at Dorsey Wright way back in the late 2000s when he was teaching me about the what he calls the generals and the troops. And what he means by that is when you look at the NASDAQ and you consider the fact that 47% of the entire index, which is hundreds of stocks, but 47% of the index is just 5 stocks. Those are what we're going to call the generals of the army. As they're going into battle, trying to win the war, trying to win the battle, what they want is they want the troops to be behind them. If we have 5 big generals leading the way into battle, and those generals turn their heads around and they look and see that none of the smaller stocks, the mid caps, the small caps, none of the other, call it warriors and soldiers are behind them, coming to support them against the enemy line, then there's going to be a problem once they actually hit the enemy line. So it's important that when we have the generals moving forward that we also have support from the troops. And while yesterday, and I'm recording this Thursday, by the way, Thursday, September 3rd, for publishing tomorrow, Friday. But so the market's down pretty big today. But yesterday, we saw some participation out of some of these troops, these metaphorical soldiers, where utilities and certain laggards that had been underperforming this past few months have actually started to perk up a little bit on a relative basis. But one day doesn't mean anything, in my opinion. I think that we need to see a trend, and we need to see more of these troops running into battle, and not just saying for one day kind of starting to run toward enemy lines and then getting maybe to 10 yards, 20 yards down the field and saying, maybe not. Maybe I think I'm going to head back to base camp here and see how these generals test the waters. So we need to have more participation, because in order for the stock market to be healthy, and in order for the stock market as a whole, and that includes the S&P 500, the Russell, the NASDAQ, or you would look at the NYSE, the Russell 3000, which encompasses almost every stock that you can invest in. In order for the market to be healthy, we need to see a lot of these stocks participating in the uptrend, and that's for a long-term uptrend, that is. So the question we have to ask ourselves right now is, what's the evidence? And whether or not we're going to see this thing continue going up from here, and for how long, and what to kind of look out for in case things start to roll over and head south. So with that being said, I know I'm kind of being, I'm trying to be objective here without seeming too negative, but if you look at these generals, like the big stocks, these big Amazons and Googles and Facebooks and Microsofts as kind of being the tide pulling in all the boats. Obviously, there are several other stocks that have been doing well and going up. So if the tide is and has been bringing the market northward, then obviously we need to participate and not sit on our hands and, from the expensive seats and watch everybody else have fun while, out in the field playing the game while, we sit around and do nothing. So you have to participate. Even if it's uncomfortable, even if it doesn't make any sense, and I think that it's pretty safe to say these days that not a whole lot makes a whole lot of sense. When you look at the economy, it doesn't make sense, but the economy is not the stock market. In fact, the stock market is a discounting mechanism for the economy and has a tendency to predict the future. I know that sounds crazy. We can't predict the stock market, but the stock market actually predicts the economy. Now, whether or not the stock market going up so much this past few months indicates that the economy is going to come back just as fast in the next few months or in the next 6 months, no clue, because we could obviously see the market head back down again in the next couple months or even after the election. But anyway, I digress. I'm just kind of rambling now at this point. So let's talk about some of the best performers that we've seen this past couple months, this past few months, really since the coronavirus crash bottom, have been the kind of work from home stuff. Obviously, Tesla has been an absolute monster. It's been just heading skyward. There's an event at the end of September. There's rumors about whether or not they're going to start making batteries for other companies, and nobody really knows what's true and what's not. And none of that matters because all it is speculation anyhow. But again, the fact of the matter is Tesla's done really well, having nothing to do with work from home. Obviously, people haven't been driving as much lately, and maybe that's part of the reason why Tesla's done well, perhaps. Because they're not planning on long trips anymore. Maybe they don't really care about being able to fuel up and keep going. So anyway, so some of the work-related home stocks or work-from-home stocks that have done well is things like Zoom, Zoom Communications, which a lot of people are using Zoom. One of the reasons Google has done well is obviously Google Meet. Microsoft owns Teams. Companies are using Teams to interact with each other both via text, or call it instant messenger, and then screen share as well for conferencing between employees. Companies like Chegg, which is online learning, Big Lots, Big Lots is a domestic company here in Columbus, Ohio, so I don't want to throw any shade at them, but I just remember in all my years, and since coming to Ohio State University and living in Columbus, Ohio, I feel like every time I went into Big Lots, it always looked like the store was going out of business. So I had a really hard time buying the stock, but it's done really well. I mean, the price is done well. The stock's done well. So companies like Big Lots, I already mentioned Amazon, but Williams Sonoma, think pots, pans, cooking at home instead of going out to eat. BJ's Wholesale, a competitor to Costco. Netflix, I don't know that. I think that Netflix is going to continue to be a great stock long term. Chewy is a relatively new stock. It's online pet food and pet products. You sit here and you go to the grocery store and you do your shopping and you've got a huge heavy bag of dog food. Maybe you don't want to take that thing home with you and have to carry it. Instead, you can have this stuff ordered online and delivered to your doorstep. It's a whole lot easier. So things like that. Etsy, if you haven't heard of Etsy, I think most people probably have. Etsy is a company where it allows small, entrepreneurs the ability to make and sell things, custom goods and things of that nature. That's done well. Lululemon, this is another one of my favorites because I've joked that I keep doing these podcasts and I keep wearing polo shirts and the last 5.5 months, I've worn a suit twice. So my poor lonely suits are sitting in my closet just collecting dust, and I'm sure I'll be wearing suits again someday. I'm not going to share how much of that has to do with my coronavirus weight that I've put on, but people are dressing down. They're working from home. They're spending money on what we call athleisure. Things like Nike, luxurious kind of athletic clothing that looks good but doesn't look like gym clothes. So Lululemon, Under Armour, Nike, things like that. DocuSign has done really well as companies have been, just like our company here, have been forced to do online signatures for virtually everything. I think since the coronavirus began, we've only had 21 face-to-face appointments here in the office, and that's compared to about 125 total appointments. So if that gives you an idea of how little face-to-face time companies might be having out there, DocuSign's a huge tool to be able to get these signatures done remotely without having to have any personal contact. Obviously, several other stocks have done well, but I just wanted to name a few sectors, industry groups that have done really well. It's going to seem obvious to you as I read these off, but online retail, cybersecurity. So online retail, people shopping online, cybersecurity, paying money to protect your computers and networks and VPNs in the case of hacking as we move to more of a work from home society. Medical devices, both for hospitals as well as at home, people who are especially the elderly who maybe if they're not unhealthy, but there's something wrong. They don't want to go to the hospital, subject themselves to higher risk. Maybe they want at-home care, so medical devices for at-home care. Home construction, builders, companies like Lowe's, for instance. The people who were usually in the past spending money on going on vacations for the summer or spring break or taking long weekend trips. A lot of that money hasn't been spent because travel's been, for some, very unsafe, and for others, just not even possible. So a lot of that money has been used to put a deck on the back of the house, to do home improvements, which is why home construction builders have done well. When you think of building companies or real estate, the reason why these companies and these sectors have done well is because interest rates are extremely low. So you got really, really low rates. You've got people not spending money on travel. And then what they end up doing with that money is because they're going to work from home, maybe they want more space. When they look for a house, they want to make sure they have a home office and privacy because they don't want chaos going on behind them, even though I kind of like the chaos. I think it adds a human element to the interactions that we have with people as opposed to it being so sterile and businessy. But needless to say, people are taking advantage of this time to maybe save up money, put additional money down on homes, home improvements, buying new homes with home offices, and taking advantage of interest rates being so low. People moving out of big metropolitan areas that don't want to be so close to other people considering the pandemic, that are looking to get out in the suburbs and kind of get away from the chaos and the close-knit communities like apartments and high-rises. That's all driven real estate. Social media stocks have done well. Software stocks, and of course it goes without saying, technology as a whole has done extremely well. So all of these, there's plenty of good that's been going on, and I think that in several markets, unless we just have like the 9/11 and the war on terror and the mortgage crisis, unless we have a tide that's bringing out all boats, that's taking all the boats, all the companies out to sea, and everything is doing poor. Whenever there's an uptrend and we have these generals that are pulling the tide in, it's going to bring other companies in and add a tailwind to these other companies. And I think that's what we've seen so far this year, since the coronavirus bottom in the market in March, is we've seen, a lot of these work from home companies and other companies, even grocery stores like Kroger, Dollar General, companies that support and bring produce and food to the grocery stores, the intermediaries. We've seen these companies do really well. So obviously everything eventually comes to an end, and that's what obviously the title of this podcast was is the markets topping out again? So let's talk more about that. So some of the risks that I see, and I'll summarize here in a second some more fundamental risks, but some of the technical risks that I'm paying attention to, and I pay attention to several, by the way, but one that's kind of staring me in the face right now is something called buying power and selling pressure. Lowry Research, one of the oldest technical analysis research companies in the country, and an old friend of mine, Paul Desmond, the late Paul Desmond, used to we used to have phone calls and exchange emails and talk about how buying power and selling pressure affects the market and how important it is. And so let me first explain what it is so that this makes sense. So buying power, if I keep this super simple, is when the market's going up, we want to see demand. We want to see a lot of buying. So on the good days in the market, we want to see things going up. On the bad days in the market, we don't want to see a lot of volume. We want to see, when the market's having a bad day, we want to see the volume low. We want to see investors kind of taking a back seat and saying, you know what, let's sit back and hold off here. On the other side, selling pressure is the opposite. So selling pressure is like supply. It's like when the sellers jump into the market. So if the market's going up and we're having bad days, we don't want to see big selling on those big days. We want to see weak selling. Or conversely, if the market's in a downtrend, what we don't want to see is big selling on those down days, and because that just indicates that the downtrend is accelerating. So if you think of buying power and selling pressure as two completely separate train tracks, we want, in a healthy market, we want to see the buying power going up, and we want to see selling pressure going down. Or at the very least, we want to see buying power, if it's going down, we want to see selling pressure going down. And so that's to make a segue here, that's what's been happening this past few months, about 2.5 months actually, is if you look at the NYSE, we've seen buying pressure going down, which would normally be kind of a concern, but selling pressure has been going down as well. So because they've both been going down, it hasn't really been as much of a concern, because what we've wanted to see is, as the market continues to go up and up and up and up and keeps getting stretched and stretched, think of a rubber band, and it's getting more and more and more stretched. And over time, the more stretched it gets, the bigger the snapback can be. So as the market continues to get more and more stretched, it makes complete sense that we would see less buying, because people kind of start to get a little hesitant and want to scale back on their new purchases. Now, with that being said, if we start to see selling pressure pick up, which we have this week, while buying pressure continues down, that's not a good thing. And that's on the NYSE. The other thing is on the NASDAQ, and this is kind of a bigger concern, but nothing that's flashing a red flag that says, sell everything and we need to worry about, the next 40% decline or next market crash. But something that is concerning right now is that the buying pressure has been going down, while selling pressure has been going up. So the buying power, just like on the NYSE, has been going down, which indicates weaker buying or weaker purchasing, while the selling pressure has been going up. So we're having kind of the opposite, almost like a convergence of selling pressure going up, buying pressure going down, which is what we don't want. Again, I want to reiterate, that doesn't mean this is the end of the world. I think what it means to me is that, could the stock market be topping? I think that we could see a pullback. I think it could have started today, this week. We may see it continue through the weekend into next week. It is September. September is seasonally and statistically the worst month of the year for the stock market. But that being said, we're also living in an election year as well. So I think that we could see a pullback, and a pullback is defined by a drop of about 5% or so. We can say 3 to 5%. You could even call a 5 to 7% a pullback, without getting too rigid here. A correction, I think we could see a correction as well. Now, a correction is defined as a drop of about 10, 15% or so. You can go up as high as 19%. Again, we don't want to be rigid here. The the statistical definition of a market crash or a bear market would be a drop of 20% or more. But I don't really care about all these detailed numbers. And, I'm not going to sit here and go, well, if the market's down 9.9%, it was a pullback, not a correction. Or if the market's down, 17%, that, well, it was kind of a crash, but not really. Let's not argue about the details. Let's just come to the conclusion that the market's gone up. It's been extremely strong in an environment that's been very scary, that's been very strange, and it's due for a pullback. So again, I mentioned earlier, it would be normal and healthy to see a pullback, and honestly, it'd be welcomed because as in our tactical models, as we've raised cash into strength as the market's gone up, it's given us the ability to have some like gunpowder. In other words, to have some cash on the sidelines to deploy and welcome such a pullback. So just to kind of summarize going forward here, let's talk about the bad and let's talk about some of the good. And I think here are the bad things. First of all, one of the bad things is bankruptcies. They continue to take place across the country. Several companies, especially small businesses, restaurants, retail, are going to, if they haven't already gone out of business, they're going to cease to exist, especially when the PPP loans are completely exhausted, which could be by the end of this month, by the end of September. There's talk in the Senate about a potential second PPP loan. I don't know how much that would help when you've got restaurants operating at a maximum of half capacity. I don't know if that matters when you consider some of the other issues, which, like for instance, a lot of the positive sentiment, I think, a lot of the positive emotions in this market have had a lot to do with stimulus packages like the PPP loan. I think it's had a lot to do with people going on unemployment and, getting a percentage of their income like they normally would on unemployment, but then getting an additional $600 per week like they were up until the end of July, which is an additional $2,400 a month, basically, which for many people, they were making more on unemployment than they were when they were working, which is a horrible incentive for people to actually get back to work and be productive and help, grow their respective companies that they work for. What it also does is it creates artificial demand because you've got this stimulus and these unemployment packages coming in, and then people are going out and they're spending that money on things, but the money's not real. I shouldn't say it's not real. It's real money, but eventually the money's going to be gone. And like I said, at the end of July, the first stimulus package for the unemployment boost ended, and while they're talking about a $400 per week plan and that 100 of it per week would be covered by the states. None of that matters to me. As long as they keep pumping this money in, I think that we could see some artificial demand coming in that's not, and I guess when I say artificial demand, what I mean is it's not demand coming in from people working, making real money and spending their real money with a positive long-term outlook. Instead, I think it's extra money that maybe they don't need in the short term, but then you have another issue, which is, millions have lost their jobs. Millions and millions of people have lost their jobs. Even if you take out the self-employed individuals, you still have millions of people without work and only about $5 to $6 million jobs available right now. And they're probably not, well, not probably, they're not the best jobs in the world. They're not the jobs you want. If you left a job as an executive at a great company, a Fortune 500 company, the jobs that are available aren't necessarily going to be the ones that you were used to working in, say, 6 months ago. So I think that's important. So even if all the jobs were filled and we take out all the self-employed, we're still talking 20 million people unemployed with literally no jobs available. So that's a problem with the economy, that is, not necessarily the stock market. Another part of it is that for those who have not lost their job, they're saving their money because they're worried about losing their job. And for those people who have already lost their job, obviously between their unemployment plus the stimulus package, the boosted unemployment, those $1,200 checks that came out, all of these things are money that's for the responsible folks anyway. They're saving their money. So I think what we're seeing in the end here is going to be, unless the economy happens to come right around like the stock market has, and we see a continuation of this strength, is I think we're going to continue to see an increase in savings and a decrease in demand effect on the market. Now, the positive there, the silver lining, is that for many, the increase in savings could mean an increase in investing, which could mean an increase in money being put into the stock market, which could again continue to drive it northward. So those are kind of the negatives or the bad that I worry about. The good, though, and I want to finish on the good because that's what I think is the most important here right now in the short term, and that is that the election is in less than 9 weeks. Any president, it doesn't matter, Republican or Democrat, doesn't make any bit of difference. Any president that wants to get reelected, which they all do, if there's anything the incumbent can do about it, the last thing they want to do is a drop in the last thing I want to see is this drop in the stock market just months or weeks before election day. That wouldn't fare well for the incumbent, obviously. So I think that no matter what happens here, if there was a Democrat in office, it would be the same, even though we've got a Republican now. They're going to want the market to go up because that's going to increase the probabilities. In fact, I believe the statistic is that the stock market has predicted the outcome of the election 87% of the time, meaning if the market's up on election day, 87% of the time the incumbent wins. And that's a pretty strong statistic going back all the way to the beginning of time in American history. So they don't want to see the president, and I guess the Republicans in office today don't want to see the market go down at all. So then you have the Fed, which is printing money, providing liquidity into the markets. Powell and the Fed are also buying corporate bonds. They've basically made a vow that says that anything above BBB rated bonds are going to be purchased. They're basically government guaranteed because the government's buying the bonds up. And then interest rates, I mentioned earlier, the other positive is that interest rates have been cut again to historic lows. I'm refinancing my house right now. If you would have told me 5 years ago that interest rates were going to be lower than they were when I bought my house, I'd have laughed at you. But here we are. I'm getting a pretty killer interest rate with a 1 to 2 month break even is all. And so you've got lower interest rates, which does two things. Obviously, it's driving, like I mentioned earlier, the home construction, home building, home improvements, and new home buying. But it's also causing what would otherwise be conservative investors who can't get any yield. They can't get good interest rates at the bank on safe investments, and they're putting it in the market. Even if it's big, right, soldiers, the big dividend-paying stocks, they're putting money into things that maybe wouldn't otherwise. They might be more conservative if they could get, say, 2, 3, 4% at the bank, but you just can't these days. So in summary, to close out today, in the short term, I think that we could expect and welcome a pullback or correction in the market here over the next several days, weeks, in September. Intermediate term wise, however, I still think that things should be positive through the election. Long term, however, after the election, all bets are off. No idea. In fact, I don't even know what's going to happen next week or next month. Who's kidding themselves here? So I have no ability to predict the future. I'm a trend follower, not a trend predictor. I'm a market analyst. I'm analyzing the market as it is today, the risk-reward landscape, and I'm just telling you how it is based on what I see out there now. But again, once we have this election, we're just going to have to see how not who wins, but how the market responds to who wins and ends up being the 46th President of the United States. All right, well, that's it for today's show. Feel free to share this episode with friends and family, and if you'd like to discuss your personal situation further, remember, you never have to be a client to ask a question. So if you ever want to set up an introduction meeting or a Zoom meeting, you can head over to our website at libertaswealth.com, and you can schedule something on our calendar. You can email us as well at info@libertaswealth.com. Or if you have questions, personal questions you want to get me personally, feel free to email me personally at adam@libertaswealth.com. And as I always say, there are thousands and thousands and thousands of podcasts. I have several I watch and listen to. It's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure, again, we're both on iTunes and YouTube, so subscribe on both. And remember, you can also sign up at libertaswealth.com to get these updates, as well as other screencasts, articles, videos, and things like that delivered to your inbox on a weekly basis. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. I'm also on Twitter, Adam Koos, and Instagram at Financial Surgeon. So again, thank you so much for tuning in and joining us today, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.